Yeah, hi everyone. I found a new spot for you all, which is down by the Williamsburg Bridge, which is not the coolest thing around here, actually. I'll tell you what the coolest thing around here is the Domino's, what was the Domino's sugar factory. That glass thing is being added as, you know, whatever it is now, some funky thing. Typical, somebody started massive pile driver right across from me and everyone complains they can't understand me. Anyway, just briefly, a turquoise blue crane is cool. And then this building is cool. And then in the background, where is it? Somewhere right back there, you can see the Empire State Building. So I'm right down by the river again, and I'm gonna skedaddle away from this guy who's about to start jackhammering over there. Okay, so it's again been an absolutely fascinating week in oil. The latest drama yesterday was the Institutional Shareholder Services saying that they wouldn't recommend investors vote for the Hess deal, which is just another plot twist. And, you know, we're slightly wrestling with this one. One interesting thing is that a lot of people, well, particularly one major shareholder came into me and said, you know, Paul, you've misunderstood this. If there's a recommendation for an abstain vote, it doesn't count as a vote, and therefore Hess only has to win 50% of a lower vote count. And with John Hess having 10% of the vote, you know, it'll be a shoo-in. But of course, that's not actually what the merger agreement says. The merger agreement says it's the majority of all existing votes. So that was, Hess actually rallied on the news, which had us a bit, which we thought was because the market's pricing a sweetener from Chevron. But now, you know, talking more to people, it basically seems that everyone is just as you were, and Chevron basically, I'm not sure, but I think they just expect to win the vote. And so if you're holding your breath for a Chevron bounce, you're not going to get it, in my opinion. Which is what we've basically been slightly agitating for, to get this deal done, because we just think it's so outrageously beneficial to Chevron. Of course, Chevron could walk away and come back, but that ultimately will be dependent on a totally separate issue, not the shareholder vote, but the arbitration vote, which is a whole lot less people. You've got to win 2 out of 3 for that one. And again, Chevron are extremely confident about that. So essentially, with a lot of drama yesterday in terms of what we were looking at, it seems that it's kind of as you were with Hess Chevron, and we'll go into the vote May the 28th. One expectation by some of the players is that they're just going to win the vote. They point out that, for example, historically, you've seen shareholder service companies advise one way, and even the quants ignore it and just vote with what's the smart thing to do. And the consideration is that it's kind of bad news if Hess doesn't sell to Chevron, because then it's sort of trapped underneath Exxon, and it's just going to have to ride this one out. People are not seeing a counter bid, which we're a bit surprised about. And that was one of the criticisms, was that it doesn't feel like Hess was heavily marketed as a takeover play at all, because if you read the S4, you'll see essentially a conversation with Chevron and not much else. And that's been frustrating to shareholders. The other thing that's frustrating to them is just the length of time that between the shareholder vote and the arbitration and the FTC, which Chuck Schumer, frankly, idiotically was saying he shouldn't allow Chevron to buy Hess because it means they can raise gas prices in the US. And we've said this many times about politicians, where they make a statement about oil and all that it tells you is they know nothing about oil, and Chuck Schumer is very high on that list. Whatever. Okay, so that's Chevron Hess, which, you know, as we've said many times, our investment thesis is just to be long Hess, because it's, we think, worth more than the bid, which is, you know, not quite the same thing as advising people to take the Chevron offer, but you know, I think it's a very good deal for Chevron indeed, and I think Hess has got itself in a bit of a tangle here, and no question management led by John Hess want this deal to complete for the benefit of Chevron, and that's where we're at. Exxon, everyone agrees, is just spoiling because they don't want Chevron to have the benefit of Guyana, because we do think that the benefit of Guyana to Chevron exceeds the present value of the future free cash flow of Hess. That is to say, from a risk mitigation point of view, it's a very, very, very good deal for Chevron indeed, especially at the price they're paying. I'm really into industrial archaeology. I studied it at Manchester University, and all this stuff just fascinates me. This was the biggest sugar factory in the world for many, many years, the Domino's factory. It's a really stunning piece of industrial archaeology. It's beautiful, and it stood vacant for many years. but now it's been thankfully taken over, and all this park is very typical of this part of New York, which was absolutely dangerously horrible for decades. And now you have like gentrifiers playing beach volleyball. Okay, elsewhere on the other thing that's out there in a pretty big way is refining shutdowns in Asia on bad economics. Asian refining economics are almost always bad, but you know, when they start having to shut down, it's the last leg of the refining balance, essentially, Asia. So it's the first thing to shut down, and it'll be a long time before Valero's shutting down, and we mean decades. But in the meantime, it signals a weak oil market right as the third thing. We head into the OPEC meeting June 1st, and we're just struggling to see what OPEC can do. Frankly, I think that their credibility is fairly shot. It's not shot from the point of view of Saudi Arabia and what they do with UAE, but for the rest of the organization, and above all, obviously, Russia, it's an absolute shambles in terms of what they say and what they do. And, you know, June 1st, Saturday, the other thing we've been saying a lot is that it's a really bad time. In fact, we got this from Kathleen Kelly, the OPEC whisperer. It's a genuinely bad time. Like the Hess shareholder vote, it's a bad time to be holding an OPEC meeting, because I got to move away from the bloody subway now. It's just noise central, isn't it? Because you know, June 1st is not the time to tell how 2H oil markets are going to play out. And the best guess is that 2Q oil market, 3Q, we should be tightening the market a lot, assuming that OPEC rolls. The problem for OPEC is everyone's expecting them to roll. So unless they roll, it becomes a very bearish outcome. If they promise more cuts, no one will believe them. So they better deliver a roll led by a very bullish sounding Saudi. Otherwise this one's going to be nothing but downside. And you know, let's stay tuned for that June the 1st meeting. I think I'll leave it there because I've been going on a bit. Broadly speaking, what we're saying is the lower oil goes, the more we like it. Go figure. So we're not whilst we do see clear weakness here, particularly in distillate, we're not you know, doom and gloom about the oil's equities. And a key reason for that is that we're arguing that if you can get lower oil volatility, which you should, then the equities multiples will expand. So the less oil bounces around like crazy, the higher the multiple, the more the market will pay for the names, on the basis that we hold a range of what we think will be 70, 75 Brent to, you know, 85, 90, 85 TI, 90 Brent. If you hold that range without breaking it, the market will increase the multiple on all the oil names, and that'll be very positive. One of the reasons we argue for the lower volatility, which we've seen and you can track it, it is lower than it was, for example, obviously in 2020. And it is in a downward trend, oil volatility is, because obviously you've got a cap on the market from Saudi spare capacity. And then of course you've got several puts. One of the puts is already being exercised, and that's the Saudi put. They protect you to the downside. The next put is the SPR put, where the US government will presumably buy more oil for the SPR below 70 if we get there. That's not that great a put, but it is a put. And then the final one we think is actually a new one because of Congress's bill that passed this last month, which is demanding that the administration enforce sanctions more strictly on Iran. And our argument is essentially, if oil gets too weak here, there'll be an outcry from Saudi, probably from the US producers for that matter, if they're allowed to, all basically saying you've got to enforce Iranian sanctions more strictly, and that is your mega put, because once you stop Iran, you'll basically reduce, you know, global oil market exports into the market from Iran by over 1 million barrels a day. And the US can essentially do that anytime they want, because they just tell the Indian refiners, the Chinese refiners, to stop importing Iranian oil, otherwise they'll get in a load of trouble with the Fed. And that works well. All right, I'm gonna go, there's another train coming. Have a great day.